Warning: trading can be a highly profitable venture, but just one wrong move can wipe out your entire capital. In this audio, we'll uncover 8 deadly mistakes that, if you're not careful, can quickly knock you out of the game. Learn what these mistakes are, how to avoid them, and set yourself on the path to trading success. Welcome to another video. Listen closely and trade wisely. 1. Indicators are tools, not strategies. Indicators are helpful tools for analyzing market trends, measuring strength, and spotting potential reversals. But remember, they're always one step behind the chart because they rely on past data. While they can give you valuable insights, they're not a complete trading strategy. A trading strategy is much more than just indicators. It includes clear rules for when to enter a trade, when to exit, and how to manage risk. It also covers things like money management, understanding your emotions, and adapting to market changes. In short, indicators are useful, but they're just one part of a bigger plan. 2. Technical analysis is just one piece of the puzzle. Technical analysis is a popular way to predict market movements by studying past price action and patterns. It uses charts, indicators, and trends to help you decide when to buy or sell. But technical analysis alone isn't enough to guarantee success. To truly succeed in trading, you need to combine technical analysis with other important factors. Fundamental analysis, understanding the economic and financial factors that affect prices. Risk management, protecting your money by managing risk in every trade. Trading psychology, keeping your emotions in check to make smart decisions. Market sentiment, understanding the overall mood of the market. Global news, staying updated on events that can impact the markets. By using all these tools together, you can build a stronger and more effective trading approach. 3. You don't need to sit and watch charts all day. A common myth about trading is that you have to stare at charts all day. The truth is, there are different trading styles, and each one requires a different amount of time and attention. The key is to find a style that fits your lifestyle and goals. Here are some popular trading styles. Scalping, making quick trades that last minutes or even seconds. It requires a lot of focus and time. Day trading, opening and closing trades within the same day. It usually takes a few hours of active trading. Swing trading, holding trades for several days or weeks. This style is less time-intensive and great for people who can't watch the markets all day. Algorithmic trading, using automated systems to trade for you. Once set up, it requires very little manual effort. You can also use tools like price alerts to notify you when the market hits a certain level, so you don't have to constantly watch the charts. The goal is to find a balance between trading and your personal life. 4. You don't always need to enter at the start of a trend. Entering a trade at the very beginning of a trend is ideal, but it's not always possible, and that's okay. There are still plenty of opportunities to profit, even if you enter in the middle or toward the end of a trend. The key is to stick to your strategy and manage your risk. Here's a breakdown of different entry points. Entering at the start of a trend. Advantages. You can capture the entire trend, maximizing your profit. The risk is also lower since the trend is just starting. Challenges. It can be hard to identify the start of a trend, and false signals are common. You'll need patience and confirmation. Entering in the middle of a trend. Advantages. The trend is already confirmed, so the chances of success are higher. Pullbacks give you a chance to enter at better prices. Challenges. You might miss some of the initial profit, and the trend could end sooner than expected. Entering at the end of a trend. Advantages. If the trend continues, you can make quick profits. It also opens the door for reversal strategies. Challenges. the risk is higher because the trend might reverse. It requires precise timing and analysis. No matter where you enter, always wait for confirmation. Use pullbacks to your advantage and avoid making emotional decisions. The goal is to stay disciplined and stick to your plan. 5. Predicting the market is impossible. No one can predict the market with 100% accuracy. Markets are influenced by countless factors, many of which are unpredictable or unexpected. However, traders can use tools and methods to assess probabilities and make informed decisions. Here are some key factors to consider. Technical analysis, identifying patterns and trends in price movements. Fundamental analysis, evaluating economic and financial data. Market sentiment, understanding the overall mood of traders and investors. Global news and events, staying updated on events that can impact markets. Instead of trying to predict the market, focus on managing risk, staying flexible, and continuously learning. Success in trading comes from adapting to changing conditions and making decisions based on probabilities, not certainties. 6. Accept failure. If you're not seeing the success you want in trading, it's time to take a closer look at your approach. Here are some common reasons why traders struggle. Unrealistic expectations, expecting quick profits without putting in the necessary work. Lack of discipline, not sticking to your trading plan or strategy. Not learning from mistakes, repeating the same errors without analyzing what went wrong. Overtrading, taking too many trades, often out of impatience or greed. Ignoring risk management, failing to protect your capital with proper risk management techniques. Emotional decisions, letting fear, greed, or frustration dictate your actions. To improve, identify your weaknesses, focus on education, and practice discipline. Trading is a skill that takes time and effort to master. 7. Balance risk and reward. One of the most important rules in trading is to balance risk and reward. Never risk more than you can afford to lose, and always aim for a risk-reward ratio of at least 1 to 2. This means your potential profit should be at least twice the amount you're risking. Remember, protecting your capital is your top priority. Profits will come, but only if you manage risk effectively and stay in the game long enough to succeed. 8. Keep a trading journal. A trading journal is one of the most powerful tools for improving your performance. By recording your trades, you can track your progress over time, identify your strengths and weaknesses, learn from your mistakes and avoid repeating them, refine your trading strategy, stay disciplined and focused.